welcome to Money Matters this week. My name is Doug Hepburn, and I'm with Hepburn Financial Advisors and an investment advisor representative of Cetera Advisors, securities investment advisory services offered through Cetera Advisors, LLC, member FINRA SIPC. Cetera is under separate ownership from any other named entity. My guest host this week is Ken Jordan from Round Point Mortgage. And Ken, how are you?
I'm doing wonderful, Doug. How are you?
I'm doing great, thanks. We've had some interesting news in the mortgage markets lately.
Yes, we have. Actually, had a big announcement yesterday.
Okay.
FHFA, the Federal Housing Finance Agency that oversees Fannie Mae and Freddie Mac, the two entities that securitize conventional mortgages, came out with their 2022 conforming loan limit. What that means is, how much of a mortgage you could borrow before it's considered a jumbo loan. Was $548,000, and as of January 1st, that goes up to $647,200. So anything under $647,000 in most areas is now considered a conforming loan. And what's interesting about that is, I think when I got in business about 20 years ago, the jumbo loan limit was $225,000.
Right.
And now it's up to $647,000. In fact, if you're buying a 2-unit property, the conforming loan limit is $828,000 for a 2-unit conventional loan before you got to get into all the crazy jumbo financing guidelines and pricing and all that fun stuff. So pretty interesting, and certainly exciting for folks that are buying or selling in that price range.
Holy cow. So, if we've gone from what, 200,000,
225 is the one I remember when I came in.
And that was 20 years ago, to over 600. That's a $400,000 increase. That's almost doubling every 10 years. So you're looking at almost a 6% increase, 6 or 7%.
And right? I don't know, historically, I don't know if that's tracking
inflation.
In our area, that outpaces appreciation. That is increasing the appreciation rate in our area. But these loan limits are set, for one number for a very broad area. So
wow,
I'm sure in some areas it's lagging appreciation rates.
Right, like California. I mean, you're lucky if you can get an apartment for $600,000.
California actually has its own number, which is a little bit higher than the 647. So that we have these areas called high cost areas. So the 647,000 is the base, and then some areas actually have a higher conforming loan limit.
Interesting. Now, do people who need jumbo loans, do they end up paying a higher interest rate or a lower interest rate?
In some cases, the interest rate's higher. But really what with jumbo loans, because they're securitized privately through investors or banks and aren't backed by Fannie Mae and Freddie Mac, the underwriting guidelines tend to be even more stringent. The down payment requirements tend to be a little tougher. In a lot of jumbo loan situations, you're required to have reserves, which is money in the bank after closing, whereas conforming loans, that's not always a necessity. You could do a 95% or a 5% down loan on a conforming loan. It's very tough to find a 5% down jumbo loan. Even just last week, if you were buying something that was in the $650,000 price range, you had to put down enough money to get the 548. If you wanted to be below conforming, or you had to put 10% down, which was $60,000. So in years past, jumbo loans have been far more stringent. Now, the gap is closing, but jumbo loans are definitely a little tougher to get than conventional conforming loans.
Interesting. I wasn't aware of that.
Mm-hmm.
I mean, you hear about jumbo loans all the time, but you don't know, unless you're in the industry, you don't know all the intricacies that surround that. I actually read an article the other day. It seems like the housing market, which was super hot from last spring over the summer, has started to, I shouldn't say cool down a little bit, but it's become more buyer friendly, if you will.
Mm-hmm.
Meaning, people aren't having to make offers without contingencies, and and make offers way above the asking price just to be able to be in the hunt. And so I think that's probably a good thing for anybody who's looking to buy a new house. But have you heard anything around that in terms of the deal flow?
We have. Now, we haven't seen an increase in inventory yet. So I believe that the lack of inventory is something that's going to continue to give sellers leverage, for at least for the next couple of quarters. But at the end of the day, the key number is days on market.
Right.
How many days does the house spend on the market? Because if a house is sold in the first 10 days, that the seller had all the leverage. The seller had 8 offers. They had
Right.
offers without contingencies. They had offers with 20% down, some of them even cash. But when the house is on the market for 45 days, that means they're sitting and waiting for an offer, an acceptable offer. Now, for the last 12 to 18 months, there's been a lot of buyers out there that want to buy, but they have low down payment, or they
Right.
need a little help with seller's assist, or they're in an FHA program, which as opposed to a conventional program, which may not be as attractive to a seller. So what I see with the days on market number is the higher that goes, the more people are going to come into the market that are kind of squeezed out over the last 18 months. But I don't see it increasing inventory too much. So I do see the sellers maintaining some hot upper hand, so to speak, in that relationship.
It's interesting you mentioned the days on market, because in this article, that's one of the things that they talked about, is the days on market is getting longer, not by much, not appreciably, but certainly it's increasing, which I guess is a good sign for buyers. So how about refinancing? I mean, you would think a lot of people would have been done refinancing by now. Is the window closing on that?
I mean, it's never quite always closed, because you still have the opportunity that a lot of folks right now are taking advantage of, which is their equity. They can cash out, they can pull money out of their property to pay off debt, to restructure debt, to do certain things, repairs to their house.
Right.
But as far as refinancing, the super low interest rates that we saw in the earlier part of this year, that activity has slowed down, and some lenders are getting squeezed because a majority of their revenue came from that type of refinancing, and with that activity slowing down significantly, we're starting to see some big name lenders take quarterly losses because their revenue line has decreased substantially, but their expenses have not.
Wow.
And restructuring could be on the horizon, but nobody wants to lay a bunch of people off, turn around, rates come down again, and now you got to go rehire. So we're in that weird window where everyone's just kind of waiting to see what's going to happen over the next 6 months.
Right. Right. Yeah. I routinely go through and try and look at the rates online, and I find it interesting that a lot of the people who are marketing refinancing are saying, "Oh, we'll just go with 0 points." Yet, but the rate is significantly higher. Is it worth it to pay points to buy a lower rate?
That question, age-old question. The reality is, it depends on how long you're going to be there. Because
Right.
if you're paying that premium for that lower payment, how long is it going to take you to recoup that premium in savings to justify the cost?
Right.
And since most people are in their home for 7 years on average, and they're in that loan for 3.5 to 4 years on average, it's really tough to justify points in a lot of cases. But if you're one of those people that says, "Hey, you know what? Here's where I'm going to be for the next 15 years," then yeah, paying points could make sense, and a lower term,
Right.
30 to a 15-year, could also make sense.
Yeah. No, you're absolutely right. Particularly, I mean, if you're somebody who purchased a home or refinanced with an adjustable rate mortgage, and you want to lock in low rates where they are now, I think that makes a lot of sense.
Yep. Absolutely.
Have we seen refinancings go down,
Yes.
or are they continuing to go through at a pretty vigorous clip?
No, the number of refinance applications has gone down considerably in the fourth quarter, late third quarter, early fourth quarter.
Wow. I wonder if that changed pricing at all, or is that because of pricing, because interest rates have gone up and
That's a great question, and the answer is yes to both. The increased interest rates have decreased decreased the activity, but like we were talking before, the decreased activity has decreased revenue.
Right.
Some of these publicly traded companies, they got to maintain certain revenue lines for their stockholders, so they're caught having to increase rates to get a better margin because they still have a revenue goal to hit. And I say like an exasperation of increased rates creep up and then they go up even further in some lending institutions because of the margins that they're required to kind of go out and get.
So, one of my observations has been that, these companies that are actually doing the refinancing, they pretty much have the rates given to them because, it's dictated by the markets. So the only way they can affect their bottom line, their profitability, is to change the closing costs. It seems as though your points and your rate are going to be pretty much the same, but and I'm talking about from lender to lender. Mm-hmm. They may have different closing costs in there just to be able so that they can make money because their margins are squeezed on the interest rate side. Is that an accurate assessment?
Sure, and don't forget about operational costs too.
Right.
What happens with a lot of lenders is they need to keep an eye on what their cost to produce is in order to determine what that margin between the coupon that's being traded on the secondary market and what they're actually charging the buyer, the overall buyer and interest rate. But rates are certainly different from bank to bank. You got to find that medium between your lowest interest rate, which is kind of internet lenders. You're kind of doing a lot on your own versus someone that is much more involved. You might find higher interest rates there.
Right.
So everybody has to kind of make enough phone calls that the decision you're making is comfortable.
Exactly. It's the age-old question of trade-offs. How much do you want to do yourself versus how much do you want to outsource to somebody else? And that's really going to determine how much you really pay.
Sure.
Well, and with all this talk about mortgage rates and interest rates, we actually have a viewer question. Grace Abbott from Philadelphia says, "Why does my mortgage keep getting sold?"
That's a great question, Grace. And I just had a conversation with a borrower today on this very topic. So what happens is some mortgage companies originate loans and they service those loans, which means that they continue to collect the money and they distribute those funds to various, tax authorities, homeowners insurance, and ultimately the end investor. Most times it's either FHA, VA, Fannie Mae, or Freddie Mac. But sometimes companies feel that their core competency is originating loans and they don't service loans. So they'll originate the loan and then they will sell that servicing. They'll sell the servicing rights to another company that actually does the servicing, the collecting of the money and the dispersing. Ultimately, almost all loans are sold and securitized by Freddie Mac, Fannie Mae, FHA, and VA, but it all depends on who you're writing your check to. And that company is the company that is servicing the loan. So, sometimes they service, sometimes they don't. Sometimes they service some loans and release servicing on others. So you never know when you're originating a loan. It's very rare that on the front end whether or not that loan is going to be kept or sold by the originating lender. But at the end of the day, this is key. Your originator, whoever helped you get that loan, if your loan ever does get sold, they should be happy to get on the phone with any customer service department of any bank across the country and help you work through any issues you have with the lender that ultimately buys your loan. Because while the company that originates a loan, they might do a great job. The company that buys the loan, maybe not. So I always say to my clients, remember, I'm here to make sure that even if we do sell your loan, I will help you handle any customer service issue that you got. Anytime you have to call customer service, I'll be on the phone with you because it tends to get things done quicker. And I think that's an important part.
That's great advice, Ken. And I'm sure Grace will appreciate that. If you have questions, we love them. Be sure to send them to us. Here's how you can do that.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com, On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
So today's guest is Paul Mitchell, Chief Credit Officer of Upland Capital Management. Paul, how are you?
I'm terrific. Good to see you, Doug.
Good to see you too. One of the things with all this talk about mortgages, refinancing, and real estate, one of the things a lot of people were really hot on for, I want to say, the past 10 years, it seems, has been house flipping.
Yeah.
And, I actually know of some people who've turned it into a business. And that's something, it sounds like you've got a lot of experience, at least seeing people and observing people who go through that. Can you tell me what your involvement is in that?
Yeah. First of all, I don't personally flip homes. I've been a commercial banker and related activities for about 35 years. So, financing small businesses, a lot of it is real estate oriented, that type of thing. But it's usually for the long haul, not a
Right.
quick haul, which is what house flipping is. So I've certainly observed it. I've had applications from borrowers that wanted to get a line of credit to do house flipping in a so-called professional, full-time, business basis.
Right.
And both actually from international sources and locally. So it's an interesting market. So what is house flipping? Let me just answer that question first of all.
Sure.
Typical situation. There, of course, there are all kinds of variances on the norm, but typically somebody will buy a house in I'll say disrepair. It's in not great shape, so they'll buy it for a bargain value. Sometimes it can be just what seems to be the value of the land itself. For example, it might be a townhouse in an area where houses in good shape sell for $300,000 plus. They'll buy this house that needs work for maybe $120,000, and their objective is to fix it up so it looks like and is the quality of the other $320,000 houses. So the objective would be to buy it for $120,000, perhaps put maybe $100,000 into it to fix it up, and sell it for $320,000 and make $120,000 on the deal before their actual the costs and stuff. So that
sounds like a great business model. And you could buy something, fix it up, flip it.
Sure.
What could go wrong?
It's very entrepreneurial. It's adding value out of thin air, which a lot of real estate is. That is a developer that puts up an office building, okay, and let's say spends $2 million doing it. 5 years later, he's able to sell it for maybe $5 million because he's got a lot of good paying tenants that show a cash flow that if you annualize it or you extrapolate it, you do all your little things to it, makes that cash flow worth $5 million.
Right.
This is buying, and typically you're going to buy it, fix it, and sell it within 12 months.
So all in all, obviously, it sounds like a good investment, right? I mean, that seems
It can be.
So what are some of the pitfalls?
Well, some of the pitfalls are that the market crumbles because you're taking at least a year to do it. The pitfall is your financing generally is going to be short term. If you're looking to flip it within a year, if you're looking for financing, the lender expects to then see that loan flip in a year or so. And if that doesn't happen, you got problems. You got a past due loan and stuff. So that's one of the things. The other thing is that maybe the project requires more work than you anticipated. Lots of examples of that, and I'll get into one in a little bit that I personally observed. So those certainly are the pitfalls. The market, number one, and number two, the individual situation, just does not work out.
Interesting.
so I guess in today's market with so many people flipping houses and it being a seller's market, you think it might be tough doing this kind of business, right?
That's right, because you're right. Prices are going to get driven up. If you have, 10 years ago, one or two people in this sort of speculative type business, now maybe they're 10, and they're looking for essentially the same type property, in a relatively decent area, maybe a changing neighborhood, that could buy, fix it up, sell it for a big price. Now you got 10 people bidding on that property. So maybe the 120,000 is now becoming 160,000 for the same thing.
How much money do you need to do a deal like that, Paul?
Well, I would typically say at least $100,000. I mean, if you can buy a house for, let's say, $60,000, what is it? Give me a break. It's going to be a wreck. So going back to even the land value, being at least $100,000, I would say. Now, so that's what you need. How much money do you need? Well, one thing is how much money is needed for the project. Maybe 120,000 to buy it.
Right.
Maybe you get financing for it. Now, how much financing can you get for it? Okay. So instead of being 120,000, maybe you only need 20,000. Maybe somebody's going to lend you 80% on that. Don't count on it.
Right. So
it's a property that is questionable. It's not saleable.
Right. So, but you basically need your acquisition cost.
Yep.
Right. And then you have your improvement costs.
That's right. And your financing costs, closing costs, et cetera.
Right. Right.
Because it's speculative type advancing. There are few traditional commercial banks that are very active in that type of business.
Oh, I can imagine. I'm sure it's fraught with a lot of risk.
Yeah, exactly. So there are other non-bank lenders that could be a real source for it, or certain banks that may specialize it and do it in a certain way with people they know are good at it. If you're inexperienced, you haven't done one yet, who's going to finance you? Who's going to finance you in any kind of business if you have no experience in it?
Is that something that Upland Business Capital looks at? Is their experience with this particular type of flipping?
Well, typically not residential real estate.
Okay.
We're typically a commercial financial consultant. We place loans with banks or non-lenders, but strictly really business oriented. Now there are businesses that that do this, and I will give an example of one. So a few years ago, I was with a bank, and there was this company that was in this business of flipping loans. And they wanted to borrow money, establish like a line of credit of, let's say, $2 million. So they would maybe borrow $100,000 per property. Okay. Well, they said, okay, we understand you're a bank and you want to be conservative and all. So we propose that you would have a first lien on the property. So let's say we buy the property for $120,000. You make a first mortgage loan of $60,000, 50% loan to value. We put in, $30,000-$40,000, and on we go. Now, when I got into it, I said, okay, well, we want to be able to evaluate, these individual loans per property. Just not going to give you, $1 million or $2 million, and you can just go around and, say we're doing $1,000 or $100,000 per property. We want to see the individual situations. I said, well, I have to admit that we don't look at them the way a bank does. I said, well, if you don't look like it the way a bank looks like, why is the bank going to finance you?
Right.
Okay. Well, so how do they look at it? Well, very entrepreneurially. Well, loan to value, they do their own kind of analysis, which is not customary or traditional.
Now, the contractor piece, it's difficult to, do the lenders typically look at the contractors as well and vet the contractors that are going to be doing the work? Or do they just simply look at it and say, here's the equity position. Our risk is such that if it goes bad, we have at least this equity today?
Yes, they should. They should do their due diligence, absolutely. And again, it goes to the experience. So if you're going to get in the business, the first couple you're going to do on your own, 100% on your own. If you want to borrow money, it's going to be friends, relatives, that type of thing, just like any kind of early stage entrepreneurial investment. After that, you can point to the experience, okay? And the experience would include What contractors did you use? How did it work out? What was your budget? How did it come out? How fast did you flip it? What did you make on it? That type of thing. How legitimate is all this? So that's one of the key things. Now, another situation I looked at recently, personally, was a friend had a neighbor. That the neighbor was an old lady. She got sick. She couldn't take care of herself. So she wasn't taking care of the house. So she moved to a nursing home. So the house was put up for sale by the relatives for $250,000, as is. No inspection would be permitted. That is, no contingencies. You see it, you buy it, close in 30 days. That's it. So somebody came around after about 4 months and bid $125,000 cash, no contingencies, nothing. Close in 2 weeks. Deal was done. Okay. Now again, the house was not in great condition. The guy knew that. He didn't know it was in that bad condition. He didn't know it really had a septic tank. It was right next to a waterway. He didn't know that the basement was just full of mold and everything had to be ripped out. He didn't know this. He didn't know that. Now, he did have family in the business, in the building supply business, so he could get lumber and things like that, and even labor at cost. But he bought the property in April of this year. He was going to move in himself in September and have his family move in November. He's still working on it.
Oh man,
the septic situation has not been resolved. So it can be really risky. You can make a lot of money on it. Okay, if you do it professionally. Most people do it almost on a part-time basis. Okay, but I'll be very, very cautious. So you can make money out of it if you spend a lot of time and know what you're doing, and maybe you have some construction business that helps. Okay, otherwise you may be taken advantage of yourself by a contractor. From my experience in living in Philadelphia, I saw plenty of look to me anyway for these flipping jobs that contractors were like plastering over cracks in the wall and that type of thing. Things that would be fine for maybe 5-10 years.
Right.
And then you would have major structural problems.
So I've heard horror stories.
It's all buried.
Yeah, I've heard them drywalling over old outlets. I've heard some bad stuff in the property flipping horror stories that I've heard.
Yeah. So another way of getting involved in residential real estate financing of that kind, not that kind, but smaller deals, a few $100,000, would be buy a house, rent it, buy some apartments, rent them and home for a few years, go for the appreciation, study how the cash flow is going to work, relative to expenses, et cetera, that type of thing. And traditional banks will finance that. I mean, they'll go through their due diligence. What's the revenue? What's the rental income going to be? 5% allocated for maintenance, 5% allocated for vacancy, this type of thing. They kind of nail it. Take that revenue and discount it, and see what's left, and then maybe finance 60% loan to value.
I think I'd rather be in that kind of business instead of the house flipping. It makes a lot more sense, Paul.
It does. Well, you're a financial advisor. You shouldn't be a terrific risk taker on behalf of your clients, I hope.
Certainly not. As an investment advisor, we have to act in our clients' best interests, and taking too much risk is certainly not for the faint of heart. Well, thanks for joining us today, Paul. This has been a great show.
Pleasure.
And just want to let everyone know that next week's guest is Dana Hamill, co-founder and COO of Descartes Therapeutics. So be sure to tune in for our next time. And in the meantime, check out our other shows online, and always remember that at Money Matters TV, your money matters.